Your neighbor earns $412,000 a year. The IRS thinks he's in the 35% bracket. He is not. On a good year, his effective federal rate is closer to 12%. And on the income that matters most to him, it's zero. He did not break any laws. He did not hide money offshore. Every move he made is written into the Internal Revenue Code in sections with numbers like 199A, 168, 1031, and 1400Z2. The brackets are public. The exits between them are not because they're secret, but because nobody who benefits from them has any incentive to explain them on camera. Today, we're going to walk through all 726 federal tax brackets. For each one, two things: who gets stuck paying the full rate, and the specific legal exit that the people one tier up are using to climb back down. Qualified business income, depreciation, donor-advised fund bunching, asset location, capital gains harvesting, Roth conversion ladders, opportunity zones. By the end, you'll understand why two people with identical incomes can pay wildly different tax, and which side of that gap is a choice. These are the 2026 federal income tax brackets for married filing jointly. 10% up to $24,800, 12% $24,800 to $108,800, 22% $108,800 to $211,400, 24% $211,400 to $403,550, 32% $403,550 to $512,450, 35% $512,450 to $768,700, 37% above $768,700. The first lesson hiding in this table is this: these brackets tax ordinary income, wages, business profit, IRA withdrawals. They do not tax everything the same way. And the entire game the wealthy play is converting ordinary income into something the table doesn't reach. Let's climb the brackets, one at a time. The 10 and 12% brackets are where the wealthy pretend to live. Who gets stuck here? Two-income working families. A household earning $90,000 of wages, taking the standard deduction, lands squarely in the 12% bracket. They pay their tax through withholding before they ever see the money. There is no exit because there is nothing to restructure. W-2 wages are the most heavily taxed, least flexible income in the entire code. The exit one tier up uses is different. This is the bracket the wealthy engineer their way back into, not by earning less, but by stacking the two things the bracket table treats gently: long-term capital gains and qualified dividends. Here is the move almost no one outside finance understands. Long-term capital gains have their own bracket system layered on top of ordinary income. A married couple can pay 0% on long-term gains as long as their taxable income remains within the qualifying range. Not a deduction. 0%. So the retired business owner lives on cash and previously taxed principal. He recognizes just enough long-term capital gain to fill the 0% bracket, then stops. On paper, his taxable income looks ordinary. In reality, he spent $200,000 that year, much of it tax-free. The 22% bracket is the salaried professional ceiling. This is where dual-income professional couples often land. Engineers, nurses, mid-career managers. Their income is reported by employers, withheld at source, and reconciled every April, with almost no room to maneuver. The 22% bracket becomes their permanent address. The exit one tier up uses is to stop being purely an employee and become, even partially, a business owner. The mechanism is the qualified business income deduction. Owners of pass-through businesses may deduct up to 20% of qualified business income before the brackets apply. Consider the consultant earning $180,000. As an employee, every dollar is taxed. The same consultant, billing through an LLC, may deduct roughly $36,000 before the brackets touch it. Thousands of dollars in tax disappear each year simply because identical work is structured differently. This is why higher earners create entities, side businesses, and alternative streams of income. The 24% bracket is the doctor's trap and the landlord's escape. Who gets stuck here? High-earning professionals, the hospital-employed physician, the corporate executive, the attorney approaching partnership. This is where the tax bill first becomes genuinely painful, and where the gap between earned income and asset income becomes a canyon. The exit is depreciation. The owner of income-producing real estate may deduct the building's value over time as though it were wearing out, even while the property appreciates in market value. This creates what accountants call a paper loss. A building generating $90,000 in cash flow may simultaneously generate tens of thousands of dollars in depreciation deductions. The owner keeps the cash. The taxable income shrinks. Cost segregation accelerates the process. Components with shorter useful lives are separated, allowing deductions to arrive sooner rather than later. In some cases, those deductions become large enough to shelter not only rental income, but other income as well. Then comes real estate professional status. Normally, rental losses offset only passive income. But if one spouse qualifies as a real estate professional and materially participates, those losses may offset the other spouse's W-2 income. This is the structure behind households where one spouse appears not to work. They are managing a portfolio, generating losses on paper, reducing taxes on salaries that otherwise would have been fully exposed. And when the property is eventually sold, the investor often doesn't sell. Under a like-kind exchange, one property becomes another, deferring capital gains taxes indefinitely. Buy, depreciate, exchange, repeat, continue until death, and heirs receive the property with a stepped-up basis. Deferred gains vanish. Depreciation recapture disappears. The tax is never paid. The 32 and 35% brackets are where giving becomes strategy. Who gets stuck here? Successful households earning $600,000 or more. At this level, common deductions become rounding errors. The exit is donor-advised fund bunching. Instead of donating annually, charitable giving is concentrated into a single year. 5 years of planned generosity become one large contribution. The deduction is captured immediately. The money is distributed to charities gradually over time. Why bunch? Because smaller annual gifts often fail to exceed the standard deduction. They generate no tax benefit, but a larger contribution in a single year clears that threshold comfortably. The strategy becomes even more powerful when funded with appreciated stock. The donor deducts the full market value and never pays capital gains tax on the appreciation embedded in those shares. Giving becomes both generosity and tax planning. Running quietly beneath these strategies is asset location. Tax-inefficient investments belong inside retirement accounts. Tax-efficient investments belong in taxable accounts. The result? Lower annual tax drag, potentially tens of thousands of dollars preserved each year, not through superior investments, but through superior placement. The 37% bracket sits at the top. Who gets stuck here? Founders after exits, executives with large equity events, surgeon investors. At this level, the question is no longer how to reduce the rate. It is how to control timing, how to determine when income appears and what kind of income it becomes. The first exit is the Roth conversion ladder. Income isn't constant throughout life. There are valleys. The year after retirement, the gap before required distributions begin. Periods when taxable income temporarily falls. In those years, traditional retirement accounts can be converted into Roth accounts. Taxes are paid at lower rates today. Future withdrawals become permanently tax-free. Required minimum distributions shrink. Future bracket pressure eases. The arbitrage between lower rates now and higher rates later becomes one of the largest planning opportunities available. The second exit is the opportunity zone. An investor realizing a major capital gain can reinvest through a qualified opportunity fund. Taxes are deferred. Additional appreciation may become entirely tax-free if holding requirements are met. A gain that would otherwise trigger a substantial tax bill is transformed into a different tax outcome entirely. 7 brackets, 7 exits. The 0% capital gains bracket the early retiree fills intentionally. The qualified business income deduction the consultant unlocks through business ownership. The depreciation strategy used by real estate investors. The donor-advised fund the surgeon uses to bunch charitable giving. The asset location decisions that quietly improve portfolio efficiency. The Roth conversion ladder draining traditional accounts during low-income years. The opportunity zone turning capital gains into long-term opportunity. None of these are loopholes. Every one exists intentionally within the tax code. Congress chose to reward business ownership, real estate investment, charitable giving, long-term capital formation. The system is not broken. It is doing exactly what it was designed to do. It taxes the salary of the person who earns it, and it forgives the gain of the person who owns the thing. The 12% bracket your neighbor appears to occupy on $400,000 is not magic. It is structure. It is the predictable result of understanding how income is characterized, how timing works, and which sections of the code transform one type of income into another. The brackets are public. The exits are public too. The only thing that isn't distributed evenly is the knowledge that those exits exist. And now, that part is yours. Next week, we follow the depreciation strategy all the way up, from a single rental property to a 1,000-unit portfolio, the cash flow mathematics, the financing structures, and the moment the IRS stops seeing you as a landlord and starts seeing you as an operating company. This video is educational, not tax advice. Every strategy discussed has conditions, phase-outs, and traps. Consult a qualified CPA before implementing any of them. Until next week.